You and your co-founders, though, made an active decision to not raise any outside capital. Could you talk a little bit about why you took that approach?
It's both compounding business as well as annuity business. A business that can potentially compound between 25 to 30%, effectively adding what you're currently managing and incremental effort and the market returns is a very, very powerful business. One of the things we have done to remain profitable is that we don't do distribution. Growth will have to come on its own at a pace at which we are comfortable with. And when you have that amount of clarity, when there are so many external influences, why are you not growing so fast? Why are you not raising money? Why are you not going to geographies outside India? You always go back to what drives you and what really you want out of this business. I still don't think that for running a PMS, you need capital. But if you want to run a successful wealth business, you probably need capital.
So Vivek, let's dive right into Agreya. It's a very, very profitable business, making a lot of money, not just for you, but also for the investors who've chosen to work with you. But before you started Agreya, you had a very successful banking career. What motivated you to leave this career and start Agreya?
First of all, as I said, thank you so much for having me. I really admire and thanks so much for showcasing some of us who have chosen the path of entrepreneurship on your podcast. So, as you rightly said, I did about 15 years of banking before I started my career. My first inspiration with entrepreneurship was actually a family office business, which I actually started with, which was started by a friend of mine, and I joined them after about 3 years. And then as there are 2 or 3 thought processes which actually are in tandem, right? The first thing is that obviously, like most of us who have worked for a long period of time, autonomy is a big thing. So I think autonomy was the first driving force for me to start Agreya. The second thing is it's actually a congregation of what I thought was really needed and what was an opportunity set. The opportunity set that we saw was that India was getting wealthy in a manner in which it is like, I think in history of money, probably China is the only other example that we can actually think of in terms of creation of absolute wealth in the last 50 years. So that opportunity was right in front of us. And then right from 90s to about early 2000, 2010, we really saw the retailization of the economy in the country. Like, for instance, everybody from a banking, everybody had a personal loan, everybody wanted a car, a house loan, all of that happened. The next phase of growth, as we saw, was this emerging wealthy class. So in absolute numbers, about 400 million people are going to get into the class over the next 15, 20 years. So today we are a $4.5 trillion economy. The moment we hit a $10 trillion economy, you're going to actually look at a vast majority of people wanting something. So that opportunity was far, far too exciting. And I think the primary driver, if I were to say, is creation of wealth, both for myself as well as for my clients. I think creating absolute wealth was the biggest driver in starting Agreya.
So you work with a lot of high net worth individuals. What do you think is the one key difference between how wealthy people think about money compared to the average investor?
So I think that's a very interesting question. There are many differences, but if I were to look at just one, I think there is a sense of possession which is there with the average investor, which you don't see with the wealthy investor. It's just merely a tool. I think what it does at a very fundamental level is how they actually access money and what money does for them. That difference actually, in all choices you make, when you have something which you think of, it's also highly philosophical, intuitive. And if you think at it from a very fundamental perspective as how you deal with your possessions vis-a-vis how you deal with your tool, there is a significant difference. And I think that's where I think beyond a number, everybody has a different number, but beyond a number, people start thinking about money in a very, very different way. And that difference is what I said, at least my perspective is what I told you just now, is that you then start using money for what it can do to you and not really worry about accumulation because you've already done or at least think that you have enough of it, right? I think that is the single most difference between the two.
What are the investment trends you're noticing among affluent clients today? Are they more open to alternative assets like crypto, private equity, or do they stick to their traditional portfolios of just equity and SIPs and FDs. What do you see in the market right now?
So when you talk about wealth, Rohit, I think there is a significant classification that you have to do, because there is a mass affluent class which is wealthy. There is an emerging wealth class which is wealthy. There is the HNI traditionally, and then there is a ultra HNI and super HNI as you call it. So each of them, today the categorization, earlier it used to be like people are poor and people are wealthy. Today you actually have a different segmentation at every level. The offering is different, and the expectation of the investor is different. The sophistication of the investor is different, and what they actually need and what they actually speak is totally different. For the longest time that I remember, at least till when I was investing as a management trainee, and then I started investing, the 60-40 rule used to be the biggest driving force, which means that people used to put some portion of their money into equities and some portion of the money into debt, and they used to have some kind of a balance, right? And that stood for a really long time. But if you look at today, especially people who have money beyond a certain number, and I really can't put a number to it today, because it's also very individual driven. There are a few people who say that 10 crores is what I want in life. There are people after 3,000 crores still want more. So I really can't say which number is the right number. But if you, depending on what your need is and what your perspective of money is and how much you think you need is, then the sophistication and the requirement changes. But if you were to generally ask about the investment trends, I think exclusivity is far more relevant for the wealthy. When I mean wealthy, I'm talking about the HNI and super HNI. And that exclusivity could be anything from assets which only a few are able to get, diversification to international markets, different asset classes like cryptos and art and whiskey and liquor and all of that. So a whole lot of bunch of things actually come into picture when you talk about that class. But if you're talking about the normal wealthy, which is essentially the mass affluent and emerging wealth, which I was talking about in my earlier segment, which is the opportunity set that we at Agreya are actually pursuing to address, then I think the move away from traditional FD to an MFs to some of the other products is something which is very, very visible. And that I think you can actually see that PMS as an industry has grown over the last 5 years, doubled in its presence. If you add PMS and alternate investment funds, I think they are significantly, today they are actually a meaningful size compared to what the MF industry was. Till even 5 years back, MF was like probably 95% of the market. Today, I wouldn't say that. Today, there are the emerging asset classes like PMS and AIF have a significant say or significant measure in the overall market participation.
Cool. So I think that gives us a good segue into the next part of this interview. Agreya's business model is fascinating to me. Managing a large AUM while remaining highly profitable. Can you break down the basic PMS business model for the audience?
First of all, I would like to say that 1,000 crore managing an AUM of 1,000 crore is not a large AUM. I would call it as a small AUM, because today, if you look at in proportion of a 5.5 lakh crore business, which is what the PMS is managed, just on the equity discretionary side. And if you actually take the non-discretionary side, it's almost close to over 20 lakh crores. 1,000 crore is actually exceedingly small. But having said that, that's fascinating for me also, right? Because when 1,000 crore is an absolute number, is a large amount of money, but in relation to the amount of wealth that is being managed, I think it's extremely small. But the business is, there are two fundamental ways you can actually run or build a PMS or a wealth platform, I would call it. So within the wealth platform, you'll have to make the distinction between who are the product manufacturers, who are basically the PMSs and the alternate investment funds, and product agnostic wealth advisor who can pretty much do everything. So the PMS AIF platform is pretty much profitable from day one if you actually build it in the right way. Because you start, it's both a compounding business as well as a annuity business. What I mean by that is because you make a small portion of income from your as a management fee from the assets you manage. It is an annuity business. You also compound because the majority of the income is actually linked to the assets you manage, and the assets themselves grow at about the market rate. And if you manage it smartly, you can actually compound without any incremental effort at about 20%, which means that a business that can potentially compound between 25 to 30%, which is effectively adding what you are currently managing an incremental effort and the market returns, is a very, very powerful business. Very few businesses actually have that kind of compounding capability, which means that at a 30% compounding rate, you are doubling every 2.5 years, right? And that is remarkable in terms of what it can actually potentially do. And some of the guys who have actually managed very much more successful franchise have compounded at much greater numbers. There are some people who in the market have compounded just from the money they've managed at about, 35-40%, which is what they have actually managed to do. In which case, your business is extremely profitable from day one. The pitfall is costs, as in many businesses. If you're able to keep your costs under control and you don't, and of course, distribution is a big cost in terms of how you actually raise your money. One of the things we have done to remain profitable is that we don't do distribution. So every single client whom we work with in Agreya is known to one of us. So it's either only through references and people who are known to us and people who can provide us a favorable reference are the people we work with. So that is one path. I'm not saying that distribution is not the way to go, but it's just a path that we didn't choose.
Could you talk a bit more about distribution costs? Is this basically a PMS using HDFC as a distributor, or what do you mean by that? And what are the costs associated with it?
So most of the financial services in the country, right? When I mean most of the insurance and banking and wealth, when I mean banking, I'm talking about wealth products, are distributed to you, whether you realize it or not. When you as a client of a bank go and open an account and then start investing in mutual funds, indirectly, you are actually creating that bank as a distributor to you, unless you choose very clearly that I want to go through the direct model, right? Similarly, when you get an insurance, almost all of the insurance in the country are sold through an agent. An agent is a distributor there. So there are very powerful reasons as to why distribution works, because the distribution is a route with which financial products gets available at every nook and corner. But having said that, there is a powerful incentive that the distributor needs, financial incentive the distributor needs, and that could vary as high as about 50 to 60% of your overall costs in terms of what gets charged to the client. So if the client is going to, let's say, pay 2% for a particular mutual fund product or a PMS product or any of the intermediary product which are sold through an intermediate business, almost 50-60% of that cost goes to the distributor, because the distributor themselves have significant OPEX cost in terms of managing the clients, right? So going through the direct model, some of the guys who actually have successfully demonstrated the direct models, the profitability is higher both for the client as well as for the manufacturer, right? But you probably will not, as I think that we have demonstrated, the scale will take much longer. So it's actually a trade-off between whether you want to go through the distribution route or you want to achieve the scale, or whether you want to go through the direct route to achieve profitability.
Makes a lot of sense. I didn't realize the distributors took that much of a cut. But that's fascinating, though.
Let me just clarify it, right? But I have nothing against the distribution business. In fact, every entrepreneur who runs a financial services business wants to build a very successful distribution franchise. We ourselves will be looking at distribution at some point in time. But having said that, the cost varies actually depends on the underlying product you sell as well. So it need not be that number which I told you. It can be even lower. But if for a typical equity product, it could be as high as that, as I mentioned, right? A debt product will be much lower for the distributor.
Let's actually talk a little bit about some of the decisions you made while building Agreya. There is a lot of VC capital flowing into the space. You see companies that deserve and so on and so forth. You and your co-founders, though, made an active decision to not raise any outside capital. Could you talk a little bit about why you took that approach?
So interesting question again. Two things, right? So one is I am in a space which the wealth, the requirement of capital is actually not a very significant part, right? As I said, it's both an annuity business and a compounding business. But where you see some of these guys taking money, and I have the deepest amount of respect for all the people who have managed to raise significant amount of money is in the wealth tech space, where people are trying to become something which traditionally used to be done by people known to you. So if you look at it earlier, it used to be the insurance agent who used to come or the chartered accountant who used to come and speak to your father, who used to tell you what the investment avenues are. Believe me, there is still a significant portion of India which actually relies on those advice to do their mutual fund advice and also their financial advice in general. But the wealth tech companies, and there are at least like 20 of them, if not more, who have raised money and who are in the process of raising money and who have actually set up successful businesses, wants to make it into a DIY model, where you as an average investor is able to go there and assess what your requirements are. And there are tools, and I think they're also coming to realize that some sort of a hybrid model is far more effective than a complete DIY model. So once you do the initial analysis, there is somebody at that space who's able to guide you and take the right decisions, or at least advise you on the right decisions which are there. We are, on the other hand, entirely a product manufacturer managing assets, investing into a very small, very tiny asset class called equity. And having said that, Agreya as a fund also manages debt. So we are a multi-asset fund house. But majority of our expertise and what we have built is on the equity side, and we are trying to build on the other side. Now, capital is required for two things, in my view. One, the business fundamentally needs capital. And as I said, if you do it in the right way, this business, or at least the business which I am managing, doesn't require too much of capital. The second, you want to achieve a certain scale for which you need capital to go and do it at a much faster pace. I think it's a choice that we have consciously made, that growth will have to come on its own at a pace at which we are comfortable with. And that is a very individual decision. So these are the two reasons. I still don't think that for running a PMS, you need capital. But if you want to run a successful wealth business, you probably need capital. But if I want to do something else, I definitely would require capital.
Let's keep things focused on building Agreya, because the thing that really stuck out to me was how much clarity you had as a leader leading this business. What's the one leadership principle you've stuck to throughout your career?
No, I was reading something this morning and somebody was saying that in financial services space in India, very contextually in India, it'll take about 10 minutes of conversation to realize that some people in the room have worked for ICICI. So I think ICICI has been one of the greatest influences for a lot of us who have actually started our own businesses. There is no doubt about the quality of people that they built, especially in the early 2000s, mid-90s. Ever since India became far more vibrant, that organization has built a lot of leaders. And one thing which keeps coming back to all of us, and I think that's something which stuck to me as well, is leading by example. There is nothing that I would want to do and I tell somebody else to do that I myself can't do. There are some limitations from a technical perspective. Somebody could be extremely good at, let's say, technical analysis or trading. I don't mean by that. But if there is certain cultural trait that I want to put forth in the organization, we have a small team, we are less than 20 people today. But even within that team, if there is anything that I would like, if I want to be on time, if I want to be disciplined, I can't behaviorally show something which is very different and expect the team to do something else. So I think that is the single most trait. Why just me? I think that's something which the four of us actually collectively believe in, and we do most of the work here. So I think that's also quite handy.
Makes sense. I totally align with that principle as well. I have this saying that I keep telling my team around servant leadership. I didn't coin this term or anything like that, but really your team needs to, you're essentially, sure, you could be the manager, you could be the CEO, you could be a co-founder, but ultimately you're still serving your team and you have to end up leading by example. So it makes total sense to me. Let's talk about your co-founders. Obviously, I took a look at the Agreya leadership team. Everyone has similar-ish sort of skill sets and backgrounds. How do you ensure that, all of you guys work well together?
So it's tough. But what helps is you are in a business where you actually have multiple co-founders. We all came together because initially the idea was we'll just trade our own way and build something for ourselves. And then I think a couple of years down the line, we realized that we wanted to start something which can actually grow into something else. And that's how Agreya formed and started. So a great amount of clarity in each of us in what we want personally and collectively. So that helps. And also the fact that we've all spent significant amount of time with each other professionally before we started Agreya. I think there's a lot of mutual respect and ability to give space because we have worked together in some form or other, almost all of us except for one, in an organization across two organizations. So that helps a great deal. I think what also helps is that at least within Agreya, I take the responsibility personally to ensuring that there is consensus is driving is an actual, it's a significant amount of effort. While we all have great amount of freedom in doing what we want to do, I think early on I realized that if you want to build something that is sustainable and if you want to build something that is very cohesive, there has to be not just ownership but also consensus to a large degree. So, but consensus building with mature, in a very matured way, respecting each other's preferences and choices is a tact. It takes a long time to build that kind of consensus. I think with also that your ability to speak your mind to each other is very, very high because of the fact that we know each other for a long period of time. While we are all similar, I think we are very different in our personality types and also what we bring to the table. I think that also helps a great deal because then we don't really second guess the other person's competence in. So if I have to think about, for instance, purely market view on a specific sector, I don't really have to go beyond one of my co-founders. Or if I have to look at a technical view, I don't have to go beyond another guy. Or if there is going to be a new initiative, nobody is going to question what Vivek is doing. So there is great amount of, we speak a lot. We take time, effort to ensure that there is a huddle every fortnight. We used to do it every week, but now it's more like a fortnight or a month in terms of trying to understand what our priorities are and what we are actually trying to achieve and where we should course correct. And that takes a lot of effort. And as I said, leadership is also a little bit about sacrifice, right? And one person will have to bear the burden of pulling the team along. And that's what we end up doing.
Really interesting. And totally agree with you on the importance of driving consensus. It may even be disagreeing, committing, but you really have to create space for people to actually speak. And
so that is a critical part, right? For instance, driving consensus doesn't mean that we don't take contra decisions. There have been many decisions that I have not been in favor of, but my co-founders have gone and taken them anyway. But that is with a full consent, saying that I don't agree with what you think, but I'm still supportive because this is something which is very important to you. I think that space and that maturity is very critical in a partnership business.
When we first met, one of the really interesting things that you told me was even in the early days of Agreya, right when you were starting out, you hired an exec coach, not just for you, but you and your other co-founders. What made you make that decision and how do you think it helped?
No, I think the reason why today we don't have an exec coach on an ongoing basis, we probably take a chat with him once a year or so. But the first 6 months, not the first 6 months, maybe after a year of starting Agreya, because the first year we were just trying to do something by ourselves. After we decided what we want to do in Agreya and set our minds into it, I think we pretty much worked with an exec coach for 6 months. It helps because, as you rightly pointed out, we are people with similar aspirations, very similar upbringings, very similar profile in terms of what we have achieved professionally. We used to work together, competitive in different organizations. So type A personalities to a large extent. So we wanted to ensure that the journey is as smooth as possible. That's pretty much what we do for our investors, even in our portfolios. It doesn't really matter as to whether I'm going to give up some equity gains in the short run. But as long as the journey is smooth, I think most of the investors are going to be happy. So we thought that even the journey in Agreya, within the growth of Agreya, or what we are trying to do within Agreya should be as smooth as possible. And it helps to have a person who's able to have that outside-in view of the four of us. Not really like, at the maturity level that we bring to the table. We don't really need somebody to actively tell us what to do, but it's easier to explain certain perspectives from a third person view rather than the person who's actually working on it or we are working on a constant basis. So I think that is what pretty much an executive coach did for us. Of course, you can use an executive coach in many ways. I'm a big believer in the fact that you need a coach, that all of us need a coach at some point in time, and a coach who actually guides us throughout. Because as a leader, you always think that there are certain things which you are not able to opine all the time. You're not able to speak out all the time. So you need somebody who is able to very objectively and also take the emotions into account and see that perspective and make you see what you're actually and be a mirror, right? And that only a coach can do at certain stage of at least my perspective on how coaches work. So this actually helped us a great deal in terms of, that's one of the reasons as to sometimes I really wonder as to why are we not fighting so much as founders, right? Why are we not having so many disagreements? But I also think that this 6-7 months, which we spent very intensely, and it was very intense. It used to be a weekly session for each of us independently and a weekly session collectively. Putting your priorities at first. I mean, it's a very cohesive way of actually looking at what your life priorities are, what your money priorities are, what our business priorities are, and what collectively you guys want to achieve together in Agreya, right? I keep talking to a lot of my friends who have set up businesses. Very few of them actually do this very consciously. And when you have that amount of clarity, when there are so many external influences which come and say that why are you not growing so fast? Why are you not raising money? Why are you not going to geographies outside India? Why are you not setting up shop like this? Why are you not hiring more people? There are so many attractions, but you always go back to what drives you and what really you want out of this business. And that sets clarity to a lot of us whenever we have that seed of doubt.
I really feel like alignment with co-founders is arguably the most important thing for a business to succeed, because if you have alignment and everyone is pulling in the same direction, but the chances of success are way higher. When you work with the exec coach or even otherwise, have you figured out any kind of useful framework to deal with disagreements with co-founders? Do you guys write things down? Do you guys have a conversation and come back the next day?
We don't have a framework per se, because personally, I don't believe in frameworks to a large extent, because that also makes you think in only a particular construct. So we don't have a framework, but I think during the process of engaging with our exec coach, what we actually said was that when there is a disagreement, there is very, very important to disassociate the person from the issue. It's easier said than done. And everybody talks about it, and you will have some fancy quotes in some of the offices which says that, when we disagree, we don't have this, so on and so forth. But I think that clearly is something which we practice in Agreya within the four of us, basically because we take time to ensure that whatever disagreement is only on the business and not on the person, right? And that, I think that maturity and that clarity is very important, because once you have the supreme respect, self-respect and respect for the other person in the room, whatever disagreements you have, I think that can be sorted out, because it's only an issue that needs to be handled. But if you're going to be hurtful at a personal level to the individual and start attacking either his ethics, capability, or his values, that I think is very difficult to overcome in my personal view. But so long as these are not questioned at all for whatever reason, and there is supreme amount of mutual respect on that as these three aspects: capability, values, ethics, then I think that truly it's easier to I'm not trying to make it so simple, but it is truly very easy to work with co-founders if you have sorted this out.
Yeah, capabilities, values, ethics makes sense as long as there's alignment in that between all four. Yeah. What were some of the mistakes you made while building Agreya Capital? Is there something that comes to mind that taught you a significant lesson?
So, first of all, we are only a 5-year-old organization. If at all there's one mistake I can think of, I think we haven't grown enough. And as I said, some of the choices we have made have rendered us like this. We don't come from equity backgrounds. You have to understand that none of us come from actually equity background. So we have to establish the fact that we are capable people in the business before we could actually start attracting capital from outside. It's not, and especially money business is so difficult to get that trust. It took us a while to understand how this business works. In retrospect, if I were to do it all over again, I would have done the first 3 years of my work before I started Agreya, because then the growth journey would have been much faster. I still keep questioning ourselves as to some of the decisions that we have made. For instance, no distribution. The reality of life is that we didn't have distributors because we were not popular, or we are not somebody known in the market, or we didn't have track record to show for in our managing money. But today, we still believe that we don't want to do distribution. So some of these questions are actually, I don't know whether they are mistakes, because some of the mistakes, as you call them, they are evident today. Some of the decisions you make, they probably turns out to be not the best decision sometime later. So it's all about choices. But what I can tell you is that we don't have too many regrets in terms of should we have done this, should we have done that, because I think that we are sorted that way. So I know it's hard to imagine, but I think we are sorted that way in terms of at least what we are trying to achieve at Agreya.
One of the things I'll tell you, right? Like I've told you this before, I've invested in a PMS before. I did not have great returns or anything like that when I invested in a PMS earlier. The most interesting, and I don't know if a lot of other people do this, but just how much time you spend with people like me and other clients, I really think that's going to be a huge differentiating factor.
Some of the clients who have come on board, they've given us just the tip of their wealth because we are new, right? But I think there is tremendous amount of scope for just deepening those relationships and making new relationships in terms of how we are building the space. People think that wealth management is actually basically happens after you get wealthy. But it's actually like you need to behave in a certain way to get wealthy. And that, I think, is a fundamental shift that is required in terms of how you become wealthy, right? And you would be amazed. You asked me early on in the episode as to what is one significant difference between the wealthy and the average investor. I think the value of money for the wealthy, it's a very controversial statement I'm going to make, but the value of money for the wealthy is far more than the value of the money for an average investor. And it's very, very counterintuitive. You would think that people who are wealthy, they would probably be a little more extravagant in their approach to spending. It's not true at all. People who are extremely wealthy really are like kanjus, to put it so bluntly, right? And that is precisely one of the reasons as to why they've gotten wealthy. Everything for them is a deal. Everything is a negotiation. Everything is like, they're tuned to think in a particular way. And I think every individual, every investor can actually get there. You just have to ensure that you don't have to become wealthy to behave like a wealthy. You have to start behaving in a particular way to become wealthy.
Awesome, Vivek. Thank you so much. Loved every single part of it. If the audience wants to reach out to you, what's the best way? Is it LinkedIn or?
Yeah, LinkedIn is a great medium. I always answer. You can also write to us. My website has some of the contact details. Happy to interact. Thank you so much for having. I had a great time too. I actually haven't done a show like this or an episode like this. So thank you so much for having me on board. Really enjoyed chatting with you.
Yeah, pleasure is all mine, Vivek.